Elon Musk is preparing to take SpaceX public at a target valuation of $1.75 trillion. To put that number in perspective, that valuation will make it the largest initial public offering in human history. At nearly $2 trillion, SpaceX would be worth more than every single American defense contractor combined. It would also eclipse the combined market capitalizations of the top 10 companies on the London Stock Exchange. Yet last year, the consolidated corporate entity of SpaceX lost nearly $5 billion. In a rational market, a company bleeding billions of dollars does not command a record-breaking public valuation. For an IPO of this size to actually work, the sellers need guaranteed astronomical demand for the stock right out of the gate, and they found it. Within a few weeks of the listing, your passive retirement account is going to act as the primary buyer for this massive, unprofitable company, completely without your consent. Public perception assumes SpaceX's value comes from rockets, but launching satellites and cargo to the International Space Station only generated about $4 billion in revenue last year. The actual engine keeping the lights on is Starlink. It's a satellite internet provider that has quietly become the fastest-scaling telecom company ever built, printing cash with massive 63% profit margins. This chart shows how the company's income breaks down. Starlink brought in over $11 billion last year, providing the vast majority of the company's total revenue. It also expands well beyond consumer internet into maritime, aviation, and highly classified defense contracts. But a toxic asset drags the entire company down. Earlier this year, SpaceX acquired xAI, an artificial intelligence lab, in an all-stock deal that burns roughly $1 billion every single month. The AI lab was purchased from SpaceX's own CEO for $250 billion. Yet by March, every single one of xAI's 11 co-founders had quit. The platform requires a complete from-scratch rebuild, making its valuation wildly disproportionate to actual revenue-generating peers in the AI space. When you look at the final math, Starlink and the rocket division generated $8 billion in solid profit, but the immense financial weight of xAI pulled the consolidated corporate entity down to a staggering $5 billion overall loss. This internal dysfunction is the real driving force behind the IPO. Insiders are sitting on a cash-bleeding corporate structure. They urgently need a way to cash out, which sets the stage for a series of highly specific market maneuvers to legally manufacture buyers. The Nasdaq 100 serves as the benchmark for top technology companies. Once a stock is included in this index, more than 200 investment products with over $600 billion in assets are legally forced to automatically buy it. On May 1st, Nasdaq adopted a new fast entry rule. It compresses the standard 3-month waiting period for price discovery down to just 15 trading days. They also completely eliminated the 10% free float minimum requirement. This explicitly allows SpaceX to qualify for the index with only 4 to 5% of its shares actually available to the public. And buried in the technical language is a hidden multiplier. Nasdaq now legally requires index funds to treat companies with a free float under 20% as if their float were 3 times larger than reality. Nasdaq rewrote the rulebook for an entire class of companies, clearing a runway for a wave of highly valued tech and AI startups to follow SpaceX's lead. Together, these 3 regulatory exploits function as a bespoke mechanism. They artificially engineer massive demand from passive index funds, completely bypassing the free market's ability to discover the actual price. The final piece of this pipeline relies directly on you. SpaceX is allocating a massive 30% of its entire initial public offering specifically to retail investors. Corporate management frames this as a reward for customer loyalty. In reality, this massive retail allocation is a calculated supply dump directly onto everyday buyers. This chart tracks the complete pipeline. Equity moves from early insiders who are sitting on low-cost shares straight into the passive index funds and retirement accounts of retail investors who absorb them at the absolute peak valuation. The set-it-and-forget-it nature of passive investing makes it incredibly convenient, but that exact same automated mechanism strips away your choice, forcing you to buy heavily indebted assets the second they squeeze into the index. Modern finance presents a new systemic danger. A rulebook rewritten so that your automated retirement savings become the guaranteed exit liquidity for failing corporate empires.